So Prospect Capital just dropped their fourth quarter earnings, and man, it is a real head-scratcher. On one hand, you've got some pretty solid numbers from their core business, but on the other, the value of their entire portfolio just took a nosedive. So let's get into it and try to figure out what is actually going on with PSEC.
And this is really the heart of the matter. How does a company beat expectations on its net investment income? Which is great news, right? But at the very same time, see its net asset value just crater by 25% over the year. Is this an operationally strong company hitting a rough patch, or is this a sign of a much bigger problem? That's what we need to figure out.
All right, to get to the bottom of this, we've got to start with the numbers. Let's break down this very mixed picture piece by piece.
Okay, let's start with the good news. Prospect's net investment income, or NII, came in at 17 cents a share. That handily beat what Wall Street was expecting, which was just 13 cents. Now, NII is the core profitability metric for a business development company like this. So this suggests their loan portfolio is actually kicking off more cash than people thought. But then you flip the coin over and whoa, the net asset value per share fell to just $6.56. That is a staggering 25% drop in a single year. So while the income they're generating looks okay, the actual underlying value of what the company owns is eroding, and it's eroding fast. This scorecard really lays it all out. You can see that NII we just talked about, but then your eyes drift over to the GAAP EPS, and it's a loss of 50 cents per share. That's where those big asset value write-downs really hit the bottom line. And revenue? Down over 21% from last year. It's a very clear story. The income from operations is holding up, but the total value of the business is shrinking. And if you're an investor, you've definitely felt this pain. Over the last year, PSEC's total return was a negative 32.4%. Compare that to its peers, the BDC benchmark, which were up almost 8%, or the S&P 500, up over 16%. So Prospect hasn't just underperformed, it's been in a different and much worse race entirely. Okay, so with numbers like that, you have to ask, what is management doing about it? Well, they've announced a major strategic pivot, and that's exactly what we're going to dig into next.
And the CEO, John Barry, he laid it out pretty clearly. The plan is to de-risk the portfolio, big time. They're getting out of the more complicated, riskier stuff and doubling down on what they call their bread and butter, first-lien senior secured loans. Now, these are basically the safest kind of corporate loans you can make because you have the first claim on all the assets if things go south.
And they're not just talking about it, they are actually doing it. Look at this. First lien loans now make up more than 70% of their entire portfolio. That's a huge shift in just 1 year. So management is definitely putting their money where their mouth is and moving towards safety. So, to break it down even simpler, what's in and what's out? Well, they're pouring capital into those safe first lien loans, and they're actively selling off the riskier assets, things like subordinated notes, second lien loans, and even some of their real estate and equity holdings. It is a classic de-risking playbook. Now you might be wondering, with that huge drop in NAV, is the company in trouble? Well, looking at their balance sheet, the foundation actually looks pretty solid. Their debt-to-equity ratio is very manageable, and they're sitting on over $1.3 billion in liquidity. And that's absolutely crucial because it gives them the firepower to actually pull off this de-risking strategy without being backed into a corner. So we've seen the tough results, and we've seen the clear plan to try and fix things. That brings us to the big question. What does it all mean for the stock going forward? Here's our take. From here, the story for Prospect really splits into two very different paths. The bull case is pretty simple. Management pulls off this pivot, the portfolio gets safer, that NAV finally stops bleeding out, and the stock's huge discount to its book value starts to close. The bear case, though, is that the credit problems just keep coming, the NAV keeps falling, and the strategy just doesn't work, which would absolutely put the dividend at risk.
So where do we land? We're initiating our coverage with a market perform rating. Look, you just can't ignore a severe NAV decline and that kind of historical underperformance. Those are serious red flags. But at the same time, the surprise NII beats and a clear, logical pivot towards safety offer a path forward. The new strategy could work, but there are a lot of ifs. For now, this is a wait-and-see, show-me story. And really, the big question now is whether this de-risking pivot is too little, too late, or if it's the exact move that will finally get this company back on track. And as always, this is not financial advice. Please be sure to conduct your own research.